What's going on, y'all? It's Mike, Pro House Seller. Welcome back to the channel. Today, I want to talk about these CPI numbers that came out the other day. So, sure if you're aware. If you're not aware, now you know. The May reports came out the other day, and the inflation in May rose 1%. So, 1% may not sound that high, but the expectation was 0.7%. So, inflation is worse than the experts and the top economists and whatnot are anticipating. And this in particular is pretty deflating because when from April to May we saw inflationary drop. I believe 2 months ago inflation was like near 9%, and it dropped to about 8.4%, 8.3%. So we were kind of hoping that inflation peaked and we would get to more in that 8% range. But 8% year over year right now is about, or inflation right now is about 8.6 year over year right now, and that's a 40-year high. That's the highest it's been since the early 80s. So that is not good, and that's just the CPI. That doesn't even include producer price index, the stuff that the business owners have to pay for. This just talks about what consumers are paying for, and this doesn't include the normal CPI. Doesn't really include core things like energy and gas. The core CPI, the things that include energy and gas, that went up 0.6% when the expectation was 0.5%. So inflation is definitely not transitory. With that, gas rising 4% in May as well. Things are just not looking good, and the Fed is trying to combat that. At the time of this video, I believe the Fed, they're supposed to have their next minutes in the next couple of days or so. So we'll find out what they're going to do. They're likely going to raise rates again another 50 or 70 basis points or something. We'll see how high. With that as well, mortgage rates are starting to go up a little bit now. Mortgage rates, I believe last week were about 5.4, 5.49, 5.5. Now they're starting to inch towards 5.6%. At the time of this recording, mortgage rates are fluctuating between, or at least a 30-year fixed mortgage rate is fluctuating between 5.6 and 5.5, so a little bit between there. The starting teaser rate on a 5-year ARM right now is actually below 4% right now. It's actually at 3.9% right now. So with that teaser rate being low, that's people are starting to feel more enticed to go towards the adjustable rate mortgages. So again, I wouldn't rule it out, but just make sure you're very sure of your financial health if you're going to go towards the adjustable rate mortgage route, because home prices are starting to fall a little bit, home sales are starting to fall a little bit, but not a lot, because inventory is just so low. So even with mortgage rates rising, that is when we're going to start to see the downturn in the housing market. Is it going to be like a 2008 type of thing? I don't think so. At least not right now. With rates rising, I still don't know if that's going to help, because the inflation isn't stopping. You can raise rates, and all it's going to do is make it more expensive for businesses or individuals or whatnot to get out of debt. And the whole system is ran off of debt. It's ran off of credit. So if you're not borrowing and spending, the whole system is going to implode. So the Fed can't raise rates too high, because then it's just going to lock out a whole bunch of people from obtaining credit and make the money velocity become a lot slower. And now we're going to go into a worse recession or maybe a depression. So a lot of people, myself included, I'm leaning towards the camp of we're already in the recession. It's just not official yet. It won't be official till sometime next month. Once they get all the June numbers, it usually takes them a couple weeks, about a month or so, to get all the numbers officiated. And I think they do another week of revising things, and then they come out with their official number. And with the numbers that we're seeing right now, inflation numbers, job reports, and all those things, it's not really looking good. So a lot of people, myself included, are a little pessimistic as to the near future of the economy. So that's that. Now, with the mortgage rates, I want to go back to the mortgage rates, because with mortgage rates, some mortgage brokers, there were people that were saying, well, just because mortgage rates are going up, they're still at a 20-year low. And that's true, but I still disagree with that, because yes, 20 years ago, back in 02, whatnot, mortgage rates were maybe 6%, and they're inching 6% right now. But what people fail to realize is that the median sales price back in 02 was $190. So your starting mortgage, not including taxes and insurance, was under $1,000, maybe $950, 6% of $190. So you're starting out at maybe maybe $950, $1,000. That was your starting mortgage plus taxes and insurance. So maybe you pay a little more, maybe $1,100, $1,200, $1,300, but that was still somewhat reasonable. So paying 6% then was somewhat reasonable. The median sales price today is $430,000. It's over $400,000. If you're paying 5% on that, your starting mortgage rate, not including taxes and insurance, is almost $1,800. That's close to double. That's close to double what you were paying 20 years ago. Even in '08, the median sales price in '08 was only $225 when rates were around 6%. So from 2000, from '02 to '08, rates didn't really change that much. And the home values didn't change that much. From '02 to '08, the home values were $190 to $225. That's only a $35,000 price jump. From '08 to now, prices almost doubled. From 20 years ago to now, prices have more than doubled. Maybe in some markets they've 3x. So it doesn't really matter. Yes, the mortgage rates are lower, but the home prices are so high. They're so much higher that it doesn't even matter. And another example I want to go to is back in the 80s, 40 years ago, mortgage rates were 17 to 18%. And people were saying, well, we had double-digit rates back then. Well, yes. But back then, the median sales price, again, was $70,000. If you're paying 17% on that, again, your starting mortgage rate is not that much. Maybe $900, maybe $1,000. That's not a lot. That's not a lot. So again, the mortgage rates are down, but home values are so much higher that people are still numerically paying more money. So yes, mortgage rates rising is an issue. Even though they're at a 20-year low, home prices aren't at a 20-year low. Home prices have doubled from 20 years ago. So it doesn't matter. It doesn't matter. You could have been paying 10% on the mortgage 20 years ago, and if you're paying 3, 4, 5, 6%, you're still paying more now, or as much now as what you're paying then. So home prices are going to have to come down. They will have to come down if rates keep rising, because people are not going to be paying $2,500, $3,000 for a mortgage, for a basic house. They're not even living in a mansion. They're living in that basic house that's been built in the 1800s. Nobody's going to pay $500,000 for that house, paying $4,000 a month on mortgage. They're not going to do that. Prices have to come down. So yes, mortgage rates are an issue, regardless of what anyone says. Even though they say they're not that high compared to historic records, they need to look at the home value. They need to look at the home values versus the mortgage rates then and now. People are paying more money numerically. So my fear, I feel like we're probably gonna enter somewhat of a mix of like a 1970s style stagflation, but there is that risk of like a 1920s style depression as well, and kind of like a combination of the two. Because what people don't seem to understand about inflation is the cost of government. Inflation is just not some natural random phenomena of prices just going up and then deflation of it coming down. No, inflation is what you pay for government, whether it's food stamps, LIHEAP, Section 8, doesn't matter, FHA, VA, it doesn't matter. All that stuff costs money. If you want the government to pay for a pothole, it costs money. Government buildings, it costs money. The money has to come from somewhere. If the government can't raise it in tax revenues, they're going to print the money. The Fed is going to monetize the debt and loan them the money. And then the prices are going to go up, because eventually the money's going to seep into the real economy, or most times it seeps into the stock market and real estate market as well. So a lot of times, people feel richer and whatnot, but that's not happening anymore, considering the whole market is down 20% year to date. So even if the Fed raises rates, that's not going to stop the government needing to pay their obligations and pay their bills. So the money's going to have to come from somewhere. It can't come from the taxpayers, because if rates are rising, they're going to be stretched. They're going to be strapped for cash. So now what's going to happen? The Fed is going to have to sell these assets and flood into the market, and the market's just going to tank even lower. Or the government's going to have to slow down their spending, which, let's be real, that's not happening. They're never going to stop spending money. And they can't raise taxes too high, because that is not popular. You're not going to be elected if you're telling people, yeah, we got to raise your taxes to 70%, man, to stop this inflation. Nobody wants to give away 70 cents of every dollar they make. So a lot of politicians right now, Joe Biden, the Biden administration, they're in a rock and a hard place right now. The Fed, Jay Powell, they're in a rock and a hard place right now. And, per Biden's last speech, letting the Fed do their job, that makes me nervous, because y'all are supposed to work hand in hand. The Fed is monetizing what you need to pay for. So if you have to do this, the Fed has to look at that and say, yeah, we'll loan you the money, or loan you the money, print the money. That's what it means. Or we're not going to do it. But the Fed never says no. So they can't act independent of each other. They have to dance together. So Biden's saying that he's going to let them do their job. They can't. The Fed can't do their job without knowing what the White House is doing. And the White House can't put all these policies if the Fed says we're not going to monetize it. So the Fed has to either put their foot down and say, hey, White House, hey, federal government, spend your money correctly, because we're not giving you no more. Or the government's going to have to say, hey, we can't stop spending the money. We have to pay for this, this, and this. We got to raise taxes. So it's pretty much pick your poison right now, and inflation's still going to go up regardless. How high? I don't know. And eventually, with Fed raising rates, I think inflation will slow down, but the prices won't come down. I think, $3, $4, $5 gallon of gas. I think that's probably here to stay I think that's here to stay for an extended period of time. I just don't think home values and inflation are going to rise. Your home, you're not going to gain 10, 15, 20% equity in a year. I think those days are coming behind us. Your homes are going to appreciate, 3%, 4% on a normal scale. Now, I think that's where we're headed in now. But it's going to be a hard. I think it's going to be a hard crash landing. I don't think the Fed can raise rates without pushing us into a recession. They can't do that, because they tried that in 2019, late 2019, and the market was feeling it. That was before COVID. That was before all the lockdowns, the pandemic. Now we went through all of that. We have all the debt. We have way more debt now. So how are you going to raise rates to 2% now when you couldn't raise it back then? So that's just my 2 cents on what's going on in the economy. Another quick update, man. Appreciate y'all, and I will see y'all in the next